Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another exciting episode of the What Matters podcast, where we explore the world of finance and beyond. I'm your host, Mike Mershazadeh.
And I'm Ashley Ward.
And today we're thrilled to have our guest, Chuck Osborne, co-founder and managing director of Iron Capital Advisors, an RIA firm headquartered in Atlanta, providing customized investment counsel to individuals and institutional clients nationwide since 2003.
Chuck is also the firm's chief investment officer and has more than 30 years of experience in the investment industry. Welcome to the show, Chuck.
Well, thank you. Thank you for having me.
It's great to have you with us here today. Let's start off by delving right into your journey. Could you share with us your story, starting in the investment industry over 30 years ago and the experiences that really led you to co-founding Iron Capital Advisors in 2003?
Sure. Well, if you want to go way back, it goes all the way to when I was in college. I was running a mock portfolio in 1987. In an economics class, and not knowing anything but being a natural smartass, I just decided to short the market, and then the market crashed in October, and I won the contest for the semester. So that started a lifelong kind of love for investing, and I've been in the business as soon as I got out of school. Prior to starting Iron Capital, I was at Invesco. I started as an analyst. I had a lot of different jobs there, worked in Poland for a while. But when I left there, I was the director of investment services for their retirement division, which they later sold to Merrill Lynch. And that was right towards the dot-com bubble had just burst, followed by 9/11 and the recession of the early 2000s and the bear market, and everyone's 401k had turned into a 201k, and I realized that a lot of people lost a lot more money than they should have, and that there were two major flaws in our business, in my opinion. The first was that it's just rife with conflicts of interest. And the second was that people did not have direct access to expert investment counsel. And so that was what motivated me to start Iron Capital. And that remains our mission today, to provide people with direct access to expert investment counsel. And also our guiding principles are, the first of which is independence, and our strong belief that one cannot serve two masters. So that's really what started the journey. And I left Invesco at the end of 2002. It took 6 months to put together the business plan, and there may or may not have been a couple ski trips in there. And then we launched Iron Capital in July 1 of 2003.
Real cool. So let me ask you this. Are you guys doing any shorting for your clients these days?
We don't do any direct shorting. No. We do actually hedge portfolios, but we don't take any, naked short positions.
Okay, gotcha. So tell us a little bit about your firm. I see that you guys have grown to well over $4 billion of AUM. Tell us about your journey there. I know the information that we get online is not necessarily relevant to how big your AUM is today. So if I'm off, please feel free to correct me there. But obviously, starting in 2003, you started from scratch there. How did you guys get to your size?
Oh, sure. Well, part of it is the nature of our business. So when we started in 2003, the business plan was solely what we refer to as institutional, and which basically helping companies run their 401k defined contribution retirement plans. for corporations, that would be 401ks. We also have governmental and some school systems, which are 403bs, but they all run on the same basic principles. And so that, dovetailed directly into what my experience was at the end of my time at Invesco, where I was the director of investments for their retirement plan division. At that time, Invesco was one of the top 7 providers in the country. And again, they sold that business to Merrill Lynch a few years later. But that was the sole business in 2003. And, we grew by word of mouth and reputation. But within 9 months, we were up to $1.5 billion in assets.
Wow.
Wow.
But that's just because of where I came from, and so those institutional relationships tend to be, they tend to be larger. Then we got into the private client business in 2005. It was my own father who motivated this. He had always managed his own money, done his own thing, and he was getting to an age where he just was no longer interested and wanted someone to manage it for him. He knew that's not exactly what I did, but he thought I would know someone that I would trust to manage my dad's money. And so I thought about everyone I knew that would take him as a client. And then I called my partner at the time and said that we're getting in the private client business. and so that was the launch of that. And then in the financial crisis of 2008, the private client business just exploded. And when, it's like Buffett says, when the tide goes out, you find out who's swimming naked. And so we ended up getting a lot of clients during that time period. And so today, if you look at it from a business standpoint, the assets are skewed. But if you look at it from a business standpoint, our private client business is about 70% of our business, and the institutional business about 30%.
Wow. When did you guys start the private client business?
2005.
Real cool.
Very cool. And so how many employees do you guys have now?
We're a boutique. We're a small shop. So we've got 6. There are 6 of us on the team. And we've been fortunate over the years. We've had very little turnover. And we kind of like to keep it that way. At least I came from a much larger organization, as did most of our other employees. And we kind of like having the boutique structure.
Wow. So 6 total employees at the entire firm?
Yes.
Wow. That's amazing. So how many of those 6 employees are actual advisors?
Well, we do it a little bit differently. I mean, because I came from the buy side of the business, and actually, I was an analyst. I ran money, and so that is my background. And my background is not a financial advisor, which I know is the norm for most RIAs. And so we do everything as a team. And there's 3 of us on the investment committee that make the investment decisions. There are 2 of us that are actually listed in our ADV as advisory reps that do most of the client interactions. But that's and then the rest is support staff. But that's how we're structured.
Okay.
Very cool. Those, now that you're at over $4 billion under management, that's, quite remarkable. Could you share with us some of those strategies and principles that you believe contributed to your firm's success?
Sure. I think the big things are, we are driven by our values. One is, again, the first value that we talk about is independence. So we believe strongly that one cannot serve 2 masters. We are strictly fee only. We're not dual registered. We are a pure RIA. and have been since the inception. Um, and and that matters a lot, especially to our institutional clients. Some of the, with our private clients, sometimes you have to explain the difference, but for our institutional clients, that matters a lot because most of our competition is is biased in some way or form, and so that has helped. The second thing we talk about is trust, and ultimately trust is built over time with relationship, but we also, as Reagan said, you want to trust but verify. So we don't custody assets. We explained to everyone that they have a separate relationship with their custodian, and we don't try to get in between that. We don't try to look like a broker. We don't want, we want them to understand that this is a different relationship than a traditional financial advisor. And so that, I think that has helped us a lot. And then finally, service. And when we talk about service, we want to talk about service that is actually meaningful to the client. So I give you a great example. In 2008, it's September 15th. I remember the date because it was my father's birthday. So bad things happened on my father's birthday. He was born in 1929, so that was not a good year for the markets. Yes. But in September 15th of 08, that's when Lehman Brothers has just gone under. AIG is on the brink. Financial world appears to be falling apart. We get to the office on first thing Monday morning, and our thought is we have got to talk to all of our clients, and we've got to talk to them now. And so we immediately, the only way we could do that at the time was we just wrote a long email that went to every single client, basically just outlining that panic is never a strategy, and we need to stay the course. A couple years after that, we actually hired a gentleman who had come from one of the big wirehouses, and we won't pick on who, but he was in his office that Monday morning, and he's being told by their managers, whatever you do, don't call a client. Our compliance is going to come to you and tell you what you can say after they figure it out. And, that's the difference. I mean, that's the difference between having someone who's independent and and when you're dealing directly with the person who's actually making the investment decisions and giving the investment insights, is that we can talk to them directly. And I think that's ultimately what's built our business, because most of our business has come from word of mouth and just referrals. And so I think our clients appreciate the way we do it, and they introduce us to others that are like-minded.
I like that. So, with the 6 individuals that have been at your organization, how long has everybody been there for?
Oh my gosh, you're testing my memory. That's unfair. You did not tell me there was going to be a memory test. So 20 years is the inception, and I am currently the only one that's been here for the entire 20 years. Michael Smith, who's our director of investments, has been here, I think, for 17 of those years. So he's been with us for quite some time. And then, I think our shortest tenured employee is going on 7 years.
Oh, wow.
So yeah, we tend to be, again, it's a great environment. For us anyway, it's, we're more like a family. That's what happens when you have such a small office environment. And so, we don't have a lot of turnover.
And with having that small of a team, are you the only owner of the RIA, or has there been other owners that have been?
Yeah. So I am, and this is why I'm listed as the co-founder, and I always will be, because I was the co-founder. I didn't do it by myself. Yes. When I put together the business plan for Iron Capital, I very quickly realized that I wasn't going to be able to do it by myself. You always need help in this life. And so I actually went to a good friend and a former colleague of mine, Larry. And Larry was my partner and helped me get started. And I bought him out. Originally, it was supposed to be in '07, but I think it ended up being in '09 because of the financial crisis. And he is now retired and very happy. And so I am currently, and have been for the last several years, the sole owner.
Wow.
Very cool.
Yep.
Leadership plays a pivotal role in shaping culture and the direction of your firm. Could you share with us, your unique leadership philosophy and the lessons you've learned to drive innovation within your firm?
In my opinion, there's only one way to lead, and that's by example. And so don't ask people to do things that you're not doing yourself. And the other lesson that you will learn and this is true really in any business, but anytime you have employees, is don't forget the old rule that when you point your finger at someone else, you got three fingers pointing back at yourself. So when you say that the office manager messed something up, well, did you really give her the clear instructions that you were supposed to? At some point you got to understand that, if you want to be in the corner office, the buck stops with you, and that if something goes wrong, then then you're the one that made it go wrong. And I think when you do that and you take ownership, I think your employees appreciate that, and they appreciate that you've got their back. If a client ever gets upset with them or anything, and that and that's what leadership is really all about. You have to do it by example. You can't just be. There's no such thing as leading from behind. Let's just put it that way.
Right. And so let me ask you this: when you are talking about building your firm there, if this again, the information that we get may not be 100% accurate, it shows that you guys have around 167 clients in total. Is that correct?
Roughly, it's it's a little bit north of that right now, but yeah, it's in that ballpark. Maybe about 180.
You know what?
Yeah.
So that I see how you guys can get it done with 6 of you now. I mean, that's still a lot of work, but I see how that it makes a little bit more sense now. So you guys, focus more on the high net worth individuals. Is that correct?
Well, no, all right. Actually, it's the institutional clients that are the largest, and so that drive a lot of the in terms of the assets under management. But the private clients are an eclectic group. We officially have stated a minimum of $1 million for new clients. But the truth is, we've never actually turned anyone down solely because of assets. We have turned down clients because we just didn't think they were a fit for what we do. And that is one thing about growth, is if you really want to grow in a sustainable way, in my opinion, you're not going to be everything to everybody. You're going to know what you're good at, and you're going to, at some point, you got to kind of recognize who will really appreciate what you're good at and who may not appreciate what you're good at. And therefore, it may be better off not wasting your time with a certain, with that individual. Mm-hmm. But that's how we do have the clients that kind of run the gamut. And I would say that our typical individual client is more the mass affluent than really a true high net worth. It's the executive who's worked a long career and accumulated, a few $1 million in their retirement plan. And they've never had that kind of money. They weren't trust fund babies. They had to work their way up through life. And now they've got to figure out, what am I going to do with this, and how am I actually going to retire? So that's really our typical client. Now, we do have some that, would be in that family office kind of range, and then we've got some that are smaller than that. But that's kind of the bread and butter client, I think.
And what do you guys see for the future of your firm there? Obviously, let's say 5 years down the road, what's on the horizon for the company there?
Mike, that's always hard to say because I always tell people I had a very detailed business plan when I started Iron Capital in 2003, and it survived for maybe a month, and then we started changing. I mean, one of the things that started right from the beginning, for example, leaving Invesco, I knew this was a startup firm. We were brand new at this. I mean, I had a great resume as an individual, but we had never done this as an individual, just as a standalone firm. And I figured that our institutional clients would be much smaller than they actually are. And I quickly learned that it was easier to go to a relatively large and sophisticated institutional client and convince them that it was okay to work with a boutique than it was to go to a really small institutional client and convince them that they needed to work with anyone to begin with. So so the business plan kind of evolved. And so, to be honest with you, what we have always focused on here is not really so much 5-year plans or those kind of things, but we've kind of focused on developing the habits that on a daily basis. So I think the better we get at doing our job, the growth of the firm kind of takes care of itself, and you got to be kind of open to how the world evolves, and that's always been kind of my philosophy. And I hate to say this because I went to Wake Forest, and my 2 favorite basketball teams are Wake Forest and whoever's playing Duke. But Mike Krzyzewski, when he was coaching at Duke, said he was not a big believer in goals. He was a big believer in habits. And the truth is, the reason probably most people need a goal is because they need that goal to be a motivation to actually establish the habits which will get them to that goal. Right. But really, when the rubber meets the road, it's the daily habits that you have that are going to drive your success.
Yeah, so I completely agree with that. I like that a lot. So looking ahead, what trends and developments do you foresee shaping the future of wealth management?
So, well, that's a big question because the truth is there's a lot of different ways to be in this business, and there's always the assumption, and anyone who's ever been audited by the SEC understands this. You spend half the audit trying to explain to the SEC what you actually do, and a lot of times just because you're an RIA doesn't mean you're really doing the same thing, and just because we kind of want to put the industry in this big bucket or wealth management or what have you. As far as those trends are concerned, I would say the 2 things that will continue to happen is it's going to continue to move more and more to the independent advisor and more to the RIA, less and less of the old school broker. And I think within the RIA business, you're going to get more and more direct investing. Now, I'm unique in that my background, I'm not a CFP. I'm a CFA. I came as really what I am in my soul is an equity analyst. That's what I spend a lot of my time doing. But I think more and more with the IRAs, you're going to get more sophisticated direct investment management. And there's been less and less of the manager approach. Because ultimately that's just a broken approach for the clients, and there's too many layers there that kind of hurt people's fees. And so I think that's I think that will continue to be a trend. And of course, we're seeing consolidation. And, I'll be honest. I mean, it's getting harder and harder to remain a boutique because of for lots of different reasons. But I think you're going to continue to see consolidation in the RIA space.
Yeah, and we've certainly seen quite a bit of that happen over the last 2 years. More and more. You said something about people are moving away from the wirehouses. I think the last time. Well, I actually do read, right? So the last article that I'd read, they said around 35% of individuals are in the boutique RIAs in these days, right?
Right.
And then that's grown significantly over the last 20, 30 years that they've moved away from the wirehouses. What do you think the future of that looks like? Well,
sure, and that may be right. The last data that I saw, and of course, this doesn't necessarily mean they're out of the wirehouse, because a lot of the wirehouses are dual registered with dual registering their representatives. But the more than half of financial advisors out there now are RIAs, or investment advisory representatives. Now 70% of those are dual registered. So you do have an enormous number of people that are still holding on to those broker dealer licenses, but the fact that you've actually now outnumber just the pure old-fashioned financial advisor, stockbroker, registered representative, whatever you want to call them. That I think that is speaks to the trend. The other thing that's happening, and you hear it all in the news, is that we keep having issues with the regulators trying to actually implement this fiduciary rule, which goes all the way back to the Obama administration, and they still can't figure out a way to do it. And the reason you can't figure out a way to do it is you can't really be a registered representative and be a fiduciary. I mean, unless you're going to just throw the dictionary out the window. There is no way to do it. The only way to do it in the long term is that people actually have to take the step of becoming fee-only registered investment advisory. Now that's going to be a transition for the industry. It's not just going to happen overnight. It's not happening overnight, but it is happening, and I think it will continue to happen as as the industry continues to grow.
So when you said that it's becoming harder and harder to be a boutique advisor, can you elaborate on that a little more?
Sure. Well, so it depends on the lines of business you're in. But for example, if you are consulting to retirement plans, you now have cases where many of the fund families and their collective trust products are pricing them based on the entire relationship of the advisor and not just the size of the plan. And so, historically, when a boutique firm could compete with a very large plan sponsor to get their business, that may not be the case going forward if you don't have, if you don't already have several $1 billion, under management that can help you with economies of scale. So that's just one example. Of course, the regulatory front is always an example. We continue, the regulatory burden continues to increase, and you have to have the resources and, frankly, the mindset to be able to do that. I do think that's been one of our advantages to why we are able to stay so slim, is that my background. Again, I was not on the sales side. I was on the buy side of this business, and I worked very closely with operations people, and so I think I came in with a little bit of a stronger operational background. Probably hurt us a little bit in terms of a sales background. I'm not that great of a salesperson, but I can manage money, and I can actually organize a money management operation that's very efficient, and that's very key. And so, um, so those are the things, though, I think that are driving a lot of the consolidation. And then some of it too is just you got guys that founded boutiques. My beard wasn't gray 20 years ago, and so we're no one's getting younger. So you do get guys that are coming up and they're like, well, what's my exit strategy? And so there's some of that as well.
Mm-hmm.
And so, shifting gears here, let's talk about artificial intelligence. It's a buzzword in the industry. Do you see it as being the next .com bubble? Are you guys utilizing it in your firm? I know those are two separate questions, but I'd love to hear your input on that.
Yeah. Well, two things about me is that first, I'm very real. There's nothing artificial about me, and I'm not all that intelligent. So I don't think that I'm the best person to ask about that. Here's what I would say about artificial intelligence. I guess I'll answer kind of the broad question first from an investment standpoint, and then specifically, to the extent we use it in our firm. New technology, anytime you have a breakthrough in technology, it never gets adopted as quickly as the zealots think it will.
Right.
And it never looks exactly like what the zealots think that it will. It also, doesn't take as long as the naysayers say. So, the truth, like most things, the truth is in the middle. And so, we don't really know exactly what AI is going to look like going forward. I think for a lot of people, probably the most realistic thing is it's really just a stronger, even more user-friendly technology. Technology continues to evolve, and that's always been the case. I remember early on in the days of Iron Capital, I was very fortunate. I was at Invesco at a time when a lot of the founders were still there, and several of them were very kind and very helpful to us when we were first starting out. And I remember having breakfast with a gentleman named Frank Bishop, who was one of the founding partners of Invesco. And he talked about how they had to, reinforce the floor. And this was pretty much when I was first started there, it was still this way. They had an entire floor of an office building, and the floor had to be reinforced because the entire floor was nothing but a file room. And it was all for annual reports. And that's how we would analyze companies. We would have to go down to that room, and they were the rolling file cabinets. So, and actually get the physical annual report and go through it and figure out whether or not, we wanted to invest in, whatever company. All of that has been replaced, by a phone. You can get all that information on your phone today. And so that's what technology does. No one really saw that coming. It just kind of happens. And I think the same thing is going to be true with AI. We don't really know exactly what it's going to look like. But that's why, and perhaps people have gotten smarter over the years. People are so excited about NVIDIA because NVIDIA's selling the shovels. They're, it's like the gold rush. You didn't necessarily want to go out there and mine gold yourself. You wanted to get out west and sell shovels and supplies to the miners. Those were the guys that made the money. And so, so that's, I think, where the investment opportunities lie. I don't think we are anywhere close to being in bubble range yet. We may be building a bubble, but I'm old enough to remember when everyone said that we were in a bubble in 95 and 96, and it went on for 3 more years. if we are in a bubble, we still got a long way to go before it blows up. The other thing is that a lot of people, when they're talking about the valuation of the market as a whole, because of the AI hysteria last year, is that it is extremely skewed. If you look at our core portfolio, our just on a price to earnings basis, our price to earnings ratio is about 5 less than the market, and our companies are actually growing faster, and so it's we're not in bubble territory right now, but that's kind of our thoughts on AI broadly. In terms of us using it, I don't know. We're not using it currently. One of the things that we talk about with our business all the time is that, we're, even though we're a boutique, we try to be very efficient. We're managing other people's money, and ultimately that's about relationship, and it's about relationship with those clients. And when you're in a relationship with another human being, efficient is not the word that you want to use. You want to be effective in that relationship, and ultimately, this has always been a relationship business. So I don't think that I think AI is going to be a tool for the people in this business. I don't think it's going to be a replacement or a threat to the people that are in this business, at least not the ones who are actually doing a good job for their clients.
Absolutely. Can you share with us a little bit more about, you mentioned the technology, but what investments and sectors are you most excited about right now? What do you see as the next wave of wealth creation?
Sure. I guess, part of that I'll back up and kind of talk about our economic view. We are one of the few last year that did not believe we were going into a recession. And we think that Wall Street keeps getting this wrong, largely because we are in a state of denial, or they are, and the government is in a state of denial about the recession that actually happened in 2022. And so we had two quarters in a row of negative GDP growth, which has always been a recession, except for one other time in our history, which I think was back in the 40s or something like that. And we certainly, no one even argues that we didn't have a corporate earnings recession in 2022, which was kind of a rolling recession. And so the reality is, I think we are not at the tail end of the economic cycle and about to hit a soft landing. We are actually at the beginning of a new economic cycle, and therefore we could have a very long way to run. And so when we, how does that impact our view of what to invest in? A lot of it is the places that have not gotten much love over the last decade. So we think diversification is actually going to work now. We think small caps are attractive. We think international is attractive. Based on our work, we are at a 2 standard deviation event with the gap between the valuations on domestic stocks versus international. And that's got to close down. The reversion to the mean is one of the strongest forces in investing. And so at some point, that gap between international and domestic has to close, and that's going to help international investors in the long term. And so those are two big areas. I think when you look down, more towards the sectors, we would not go away from technology. We are actually slightly underweighted technology, but that means that technology currently in our core portfolio is still over a quarter of the portfolio. So that just tells you what's happened, how skewed the S&P has become. We wouldn't go away from it, but there's going to be a lot of other areas that we think should benefit. We like healthcare, we like financials. We still like energy. Oil is stuck in a range, and energy companies are basically printing money at this value for oil, and they're still very cheap. So those are some of the places that we like the most.
So
Thank you.
I like that you touched on that. Lastly, let's touch on the economic outlook. Right, there's been so much that's happened over the last couple of years since the pandemic.
Right.
We've seen volatile swings in the markets. Interest rates have at least I follow the 10-year. Went from 0.5% all the way up to 5%.
Yeah.
What's your opinion on that? Where do you see all that playing out?
So, great question, and that feeds a little bit into what I was just talking about in terms of our outlook. We do believe that we are at the beginning of a new economic cycle, that we are not about to go into a soft landing or recession. At least that's our base case scenario. I mean, there's always some probability, and anything can happen. But as far as rates are concerned, we had I guess what was normal, and then we had the new normal, and then we had the new normal. I'm saying that we are back in the normal, which is that we have 10-year that is going to be pegged around 4%.
Yeah.
And that, I'm old enough to understand that that's actually normal.
Right.
That 2%, which is where we were pegged for a long time. I know it got down much lower to that in certain, but if you look at it for a long term, over the 20-year period of time, we had roughly 2% 10-year Treasury, and we traded around that. And now I think we're going to have a 4% 10-year Treasury, and we're going to trade around it. So it may go up to 5, it may go down to 3.5, who knows? But ultimately, I think you're going to have that force of gravity right around 4%, which is the normal. And so I think from an economic standpoint, listen, if you are about to start a business and you're running a financial projection, and the difference between a 2% 10-year Treasury and a 4% 10-year Treasury means you're going forward or not going forward, then you don't have a sufficient return on investment on that project to go forward, period. I mean, 2% is not going to stop people from doing things. And I think that we are a little bit more bullish and a little more productive for the economy going forward. And thus far, knock on wood, we've been right. So hopefully we continue to be.
Thank you.
Thank you, Chuck. Well, I think that wraps us up for today. Thank you so much for coming on to the show and sharing your expertise and insights with us. It's been a pleasure having you join us today.
Thanks, guys. We appreciate it. Enjoyed meeting you.
Yes, thank you. And to our listeners, thanks for tuning in to another episode of the What Matters podcast. Stay tuned for more thought-provoking conversations with industry leaders. Until next time.